In my book, capital gains is split into 3 chapters. Capital gains is split into 3 chapters. For the sake of convenience, I'm going to start in the same sequence. Pages turn pandradhukku. Yes, we're starting with the first chapter called as capital gains. Income tax simply comes and says that, boss, if you have to make a transfer of a capital asset, it will be taxable under the head capital gains. Will be taxable in the previous year in which the transfer took place, which means 2 conditions to be satisfied. 1, there should be a capital asset. 2nd, there should be a transfer. 3rd, there should be taxable only in the year in which the transfer took place. Will be taxable in the year in which the transfer took place. Please understand, I am telling that it will be taxable in the year in which the transfer took place. Payment of tax can maybe happen in different year. Payment of tax may be happening in different year. We'll understand that. Right now, this is what the provisions are. Yes. What do you mean by capital asset? Income tax is coming and saying capital asset means any asset of the assessee except for stock and trade. But they're also removing anything called as movable personal effects. In the movable personal effects also they're coming and saying some items are not removed, which means these items are still there. What are those items? BA pass DJ. Bullions, archaeological collections, paintings, any work of art, chairs and sculptures, DJ, drawings and jewelry. Yes, these are all the items. These items, though they are movable personal effects, are still taxable. These things have to be kept in mind. Either tavara, if you have fridge sale, phone sale, mobile sale, all these are non-taxable. Unless and until they are business assets. With me till here? Yes. At the same time, they're also clarifying that, boss, when you're talking about immovable properties also, it's not every immovable property which is taxable. I am not taxing rural agricultural land. Which means you need to understand what is a rural agricultural land. Income tax comes and says rural agricultural land is those land which is not an urban agricultural land. So what is urban agricultural land? Urban agricultural land is those kind of lands where the population has gone beyond 10,000. So if you have a land in a municipality where the population has gone beyond 10,000, it is called as an urban agricultural land. Assuming your land is not in the municipality but within 2 kilometers, same 10,000. If it is not within 2 kilometers, it is within 6 kilometers. Then the population has to become 1 lakh. The overall population from that municipality to that 6 kilometers has to be more than 1 lakh. Then it will become urban. Otherwise, it is rural. If it is anything beyond 6 but up to 8, it is 10 lakhs. And if it is anything above 8, it is always rural. This is what the criteria are. And this distance which you are looking at is distance from the aerial level. With me till here? Yes. Now this is what your capital assets looks like. Capital assets in income tax are defined into 2 models. One is called short-term capital assets. One is called long-term capital assets. They all are decided by short-term and long-term basis your period of holding. Income tax comes and says that, boss, if you are having any kind of zero coupon bonds, listed securities, UTI mutual funds and equity oriented funds. All these items will have a short-term capital asset if the period of holding is less than 12 months. If it is more than 12 months, it is long-term capital asset. If, Rahul, these are not the assets, then it is immovable property, unlisted securities. Those will become 24 months. If, Rahul, this is also not there, then it is 36 months. 36 months will be comprising of debt, equity and all those things. Yes, your slump sale, debt equity funds, business unit trust, all those items. Yes, all those items will become your long term if it is 36 and above. Clear? Yes. Then after you classify your assets, you have to define what is transfer. Income tax comes and says transfer is sale, exchange, extinguishment, relinquishment, conversion, compulsory acquisitions, all those items. At the same time, they're coming and saying that, boss, there are some items which may not be regarded as transfer. From exam perspective, not everything is important. Some items which are important is any kind of gifts is not regarded as transfer. Any kind of partition of HUF is not regarded as transfer. Any kind of gift is not regarded as transfer. Any kind of partitions of HUFs are not regarded as transfer. And then they are coming and saying that, boss, if you have any kind of transfer between holding subsidiary holdings, amalgamation, demerger, business reorganization, conversion of assets into, conversion of shares into debentures into shares, in the mechanism vechalo, everything is not taxable. Everything is not taxable. At the same time, they are also clarifying that if you have received any kind of asset under a reverse mortgage, under what? Reverse mortgage. What is a reverse mortgage, Rahul? I have given my land, I have given my building to bank in exchange for getting monthly income. In exchange of getting monthly income, which will later on be repaid back. When I transfer my capital asset to the bank, it is not regarded as transfer. When the bank sells the asset, it is not regarded as transfer for the bank. It is regarded as transfer for me. Any payment which is coming from the bank to me is also not taxable. Which means in the whole transaction of reverse mortgage, only one item is taxable, which is the sale of the house. And that is also taxable in the hands of the senior citizen. Yes or no? Yes, this is what your transaction is not regarded as transfer. Simple, straightforward game. Yes. After that comes your format. You have two different formats for your short-term capital gains and long-term capital gains. Income tax is coming and saying that, boss, if it is short-term capital gains, you start from full value of consideration, reduce your cost of transfer, you will arrive at net consideration, reduce your cost of acquisition, cost of improvement, you will arrive at short-term capital gains. But if you are in a long-term capital gains model, you will start from full value of consideration, cost of transfer, net consideration, indexed cost of acquisition, indexed cost of improvement, long-term capital gains. And then you have certain exemptions. Yes or no? Now when you come to capital gains, I told you that anything which is taxable in the previous year in which the transfer takes place, but there are certain exceptions. Exception number one is your insurance compensation. Income tax comes and says that, boss, whenever you have an insurance compensation will be computed in the year in which the asset is destroyed. But will be taxable only in the year in which the money is received. Yes. Exception number one, they are coming and saying that the asset is taxable in the year in which the asset is destroyed, but it is paid only in the year in which the asset is received, which means if you have to do any kind of indexation will stop on the date on which the asset is destroyed. Yes or no? Yes. Next item is, after insurance compensation, you have conversion of capital asset into stock and trade. Question is coming and saying that, boss, if you have converted your capital asset into stock and trade, the taxability will happen in the year in which the asset is converted, but the payment will happen only in the year in which the asset is sold. Yes or no? Yes. Rahul, how do you convert? You convert it using the fair market value on the date of conversion. Okay. So from the capital asset, the sale value will become the fair market value of the cost of the asset, and for the stock in trade, the cost of acquisition will become fair market value of the cost of conversion. Fair market value on the date of conversion. Yes or no? But the same in the reverse scenario will not work. If you are converting your stock in trade into capital asset, the stock in trade will be taxable in the year in which the asset is converted. The capital asset will be taxable in the year in which the asset is sold. Rahul, how to keep the difference? The logic is very simple. Capital gains can be deferred. PGBP cannot be deferred. Look at the sequence of events. If PGBP is happening first, PGBP will happen first. If capital gains is happening first, capital gains will happen along with PGBP. With me till here? Yes. After you complete your conversion, next item is called as compulsory acquisition. The next item is called as compulsory acquisition. Income tax is coming and saying that government has the authority to buy over your property forcefully also. In case they buy over your property forcefully also, the date on which the asset is compulsorily acquired from you will become the date of transfer. Tax will also be computed on such date. But the tax will be paid in the year in which the first installment is received. This is what the rule is. Yes or no? Now, in case you have taken a further appeal, income tax is coming and saying you will receive something called as enhanced compensation. Now, enhanced compensation will also be taxable in the year in which it is received. And the nature of the enhanced compensation will be the same as the original compensation. But at the same time, in case the enhanced compensation came to you by way of an interim order. What order? Then in that case, I cannot tax it on the date of receipt. I will tax it on the finalization of the order. Nature of the enhanced compensation will remain the same as the original compensation. Rahul, how do you compute this? This is how it will look like. This is how it will look like. You have initial compensation, your full value of acquisition, full value of consideration minus index cost minus index cost of improvement, you will get your capital gains. Enhanced compensation, if you have received something by interim order, tax it in the year of final order. If you received anything else, you will be taxing in the year of receipt. There you will have a full value of consideration, which is nothing but the amount which you received minus any kind of any legal cost which you incurred, minus any kind of legal cost which you incurred, you will arrive at your capital gains. You will arrive at your capital gains. This capital gains will be the same as left capital gains. The capital gains on the right will be the same as left capital gains. The same period of holding will apply. Everything else will be the same. Everything else will be the same. Yes or no? Yes or no? Then they are also coming and saying that, boss, along with enhanced compensation, if you also receive an interest, then in that case, interest will also be taxable in the year in which it is received, will be taxable under the head IFOS, will be allowed over a period of, will be allowed 50%. Will be allowed 50% of the income as deduction. Will be allowed 50% of the income as deduction. The next item I think is called a specified agreement. You can ignore it from exam purposes. You can ignore it from exam purposes. Clear? Yes. Coming back, if you notice the format, I told you it is full value of consideration less cost of transfer, coming at net consideration, reduce cost of acquisition or indexed cost, and then reduce cost of improvement or indexed cost of improvement, arrive at your capital gains. Let's look at the items one by one. The first item is full value of consideration. Income tax is coming and saying full value of consideration is the consideration which you have received. The consideration which you have received. In case you are not able to find out the consideration, consideration will be deemed to be the fair market value. Consideration will be deemed to be the fair market value, but there are some exceptions to it. One exception is where they are coming and saying if you have done an immovable property. If you have had an immovable property, in case of an immovable property, if you have sold that immovable property for lesser than the stamp duty value, then you will take the full value of consideration as the stamp duty value, but you will not do this nonsense if the stamp duty value is within 110% of the consideration. Is within 110% of your consideration. This is section 50C. This is section 50C, where they're coming and saying stamp duty value or full value of consideration, whichever is stamp duty value or actual consideration, whichever is higher, but ignore this provision if the stamp duty value is within 110% of the consideration. At the same time, they're coming and saying, boss, if you have two stamp duty values, you have to take the stamp duty value on the date of registration, but you can also take the date of agreement if you satisfy two conditions. If you satisfy two conditions, condition number one, you should get advance money. Condition number two, the advance money is paid through permissible modes. Third, they are coming and saying, Rahul, if you are not happy with the stamp duty value, you can go and fight with the valuation officer. If a valuation officer comes and gives you a value lower than stamp duty value, take the value. If the valuation officer is giving a value above the stamp duty value, ignore the valuation officer, take the stamp duty value. Take the stamp duty value. This is what the provisions are. Yes or no? Yes. Something similar like this is also there for unquoted shares, where they are coming and saying if you have sale of unquoted shares, you have to take the actual consideration or the fair market value, whichever is higher. Whichever is higher. Yes or no? Yes. This is your full value of consideration. Next item is cost of transfer. Income tax is saying, boss, any direct cost which you incurred for transferring will be allowed as a deduction. You will not be allowed anything called as STT. What if? Any security transaction tax which is incurred is not allowed as an expense. Is not allowed as an expense. You will arrive at something called as net consideration. In the net consideration, you have to remove cost of acquisition. You have to remove cost of acquisition. Income tax is coming and saying cost of acquisition is the actual cost which you incurred. Is the actual cost which you incurred. But yes, there are transactions where transactions are not regarded as transfer. The examples we did, gift, transfers and all those things. Yes, in all those cases, cost of the new owner will become cost to previous owner. Cost of the previous owner. This is what the provisions are. Yes, cost of the new owner will become cost of the previous owner. Period of holding will also be from the previous owner. But indexation will start from, the indexation will continue to start from the new owner unless and until you opt for Manjulasha. Unless and until you opt for Manjulasha. If you opt for Manjulasha, then it becomes previous owner. Then it becomes previous owner. Your choice what you want to do. Make sure you put the notes. Make sure you put the notes. But Rahul, assuming that I bought this asset before 2001. Yeah, assuming I bought the asset before 2001. Now there is a problem because my indexation only starts from 2001. Income tax comes and says, no worries, boss. In that you can take the actual cost or FMV, whichever is higher. Actual cost or FMV, whichever is higher. But if it is an immovable property, you have to compare FMV with SDV also. FMV and SDV, whichever is lower, compared with your cost, whichever is higher. Compared with your cost, whichever is higher. This is what the provisions are. Okay, this is what the provisions are. Look at the example. It comes and says that your actual cost in scenario 1 is 100, your FMV is 110, your SDV is 90. What will you do first? 110 or 90, whichever is lower, which is 90, compared with 100, whichever is higher, therefore 100. Next, 100, 120, 110. 110 and 120, whichever is lower is 110, compared with 100, whichever is higher, therefore 110. 100, 130, 120. 130 or 120 is 120, compared with 100 is 120, therefore 120. Yes, this is only if it is an immovable property. This is only if it is an immovable property. Keep that in mind. Yes. Next thing they're coming and saying, Rahul, if you have an asset which you have got on account of gift, if it was not a taxable under gift, then it is cost to the previous owner. But if it was taxable under gift, then whatever value you paid on tax, that is what the amount is. That is what the amount is. Yes or no? Yes. This is what your normal cost of acquisitions are. Anything else is not so important. You can ignore it and go. Next thing is your cost of improvement. They are coming and saying, boss, any asset cost which you incurred, which is improving the asset on a significant level, is called as cost of improvement. General repairs and all is not considered. It should be a capital cost of improvement. If you have incurred this capital cost of improvement before 2001, ignore. Before 2001, you have to ignore. If you have incurred it after 2001, you can consider it, provided you have capitalized it. If you have not capitalized it, you will not get the deduction. This is what your cost of improvement looks like. Now, both the cost which you have, the acquisition and improvement, can be indexed if it is a long-term asset. Where income tax is coming and saying you can take an indexation benefit by using the formula cost of acquisition into CII in the year of transfer divided by the CII in the year of acquisition. You don't have to remember anything on the acquisition CIIs. Only one you have to remember, which is 2001, which is 100. And your current year transfer year is 331. Yes, so this is 2 you have to remember. So it is 331 for the year of transfer, 100 for the year of acquisition. Acquisition can change. If it changes, income tax books, ICI will come and tell you that number. Yes or no? This is what the provisions are. Then we can move to special scenarios. The first special scenario, income tax is coming and telling us, boss, you have issued bonus shares. What have you issued? Income tax is coming and telling that, boss, if someone has got bonus shares, the cost of acquisition in the new person's hand will become 0. The cost of acquisition for a bonus shares is 0. But if you have got the cost of the acquisition before 2001, then it is fair market value. Because it is fair market value or actual, whichever is higher. Therefore, it becomes fair market value. Rahul, no, it is not bonus, it is a rights. Ask yourself, are you availing the right or are you transferring the right? If you say, no, Rahul, I am availing the right, then in that case, cost of acquisition for you will become the price you pay to the company. If you say, no, Rahul, I am actually transferring the right, they'll come and say, okay, boss, then you transferred. No, you got an income. So your sale value will be the money which you got. Cost will be 0. Because you did not incur anything for this. That will become your pure capital gains. I am the person who has bought it from someone else. In that case, I've paid 2 costs right now. One cost is to buy the rights. Second cost is to buy the shares. In that case, my cost of acquisition will be the rights price plus the share price. Both will be added to my cost of acquisition. My period of holding will start from the date on which I get the shares. Simple as that. Yes. The next special scenario, they're coming and saying that, boss, you have depreciation assets. What assets? Depreciation assets. Income tax comes and says, generally when it's a depreciation asset, capital gains will not come into picture. You will always do PGBP. There are only 2 scenarios where capital gains will come into picture. Scenario number 1, the block is fully gone. You have not even a single asset in the block. Scenario number 2, the block is still there, but the sale value is so high that the cost has become lower. The sale value is so high that the cost has become 0. In that 2 scenarios, income tax comes and says you come to capital gains. Forget PGBP, come to capital gains. In capital gains, they will come and directly say take the sale value, less the WDV. That will become your capital gains. And income tax very clearly clarifies that, boss, if it's a depreciable asset, capital gains will always be a short-term capital gains or a short-term capital loss. It will always be a short-term capital gains or a short-term capital loss. Cannot be anything else. Yes or no? This is what a depreciable assets looks like. After depreciable assets comes, this is what we have discussed. 50C is done. Then comes your forfeiture. Income tax is coming and saying that, boss, if you have any kind of forfeiture of income, what do you have? Forfeiture of income. Tell me whether the forfeiture happened before 2014 or after 2014. If the forfeiture happened before 2014, you will reduce it from the cost of the acquisition. Rahul, will you reduce it from cost of acquisition after indexation or before indexation? Before indexation. If you have done this forfeiture after 2014, then directly IFOs. At the same time, please understand, you have to reduce it from cost of acquisition only if you are the person who has forfeited it. If someone of your predecessor has done it, then you don't have to do it. It will not be reduced from your cost of acquisition. That will become a free profit for the old person. With me till here? Yes. Have you completed your, since you have completed your gross long-term capital gains and gross short-term capital gains, now comes something called as exemptions. From exam perspective, there are only 3 exemptions to keep in mind. First is 54. Second is 54F. 54 EC. 54 and 54F come and say that you have to obtain a house property. For this, if you sell a house property, it is 54. If you sell any other property, it is 54F. That is what the rules are. Where they are coming and saying that, boss, if you are planning to buy a house property, you can buy one house property. But yes, if you are in 54, where are you? You are in 54, and I find out that your long-term capital gains is less than 2 crores. In that case, I am permitting you 2 house properties also, provided it is once in lifetime. In 54, they are coming and saying what you should deposit is the capital gains. In 54F, they are saying what you should deposit is the net consideration. When should you buy the asset, Rahul? 54 comes and says if you are buying it, then it is 1 year before or 2 years after. If you are constructing it, it is within 3 years. Whether you go 54 or 54F, it doesn't matter. Okay, this is what the rules are. And then they're coming and saying, boss, if you have bought an asset, good. But if you're not able to buy the asset within the due date of filing of return of income, please deposit this money in an account called as CGAS. If you deposit the money within CGAS, within the due date of filing of return of income, I will assume that you have bought the house. But you have to buy this house within the specified time. If you don't buy the house in the specified time, whenever you make a miss out, that year I will tax it off for you. Next, they are coming and saying that, Rahul, if I have an asset which is the new house property, I have to hold it with me for a period of 3 years. If I don't hold it for a period of 3 years, income tax comes and says, check and tell me whether the old asset and the new asset are the same. If you tell me, Rahul, that the old asset and the new asset are the same, then what I will do is whatever exemption I claimed earlier will be reduced from the cost of the acquisition. Which means in 54, house and house same. So what will happen is in the new asset, I will reduce the exemption of the cost. I'll reduce the exemption from the cost. And I will do new capital gains. But if it is 54F, income tax says, boss, different assets, so don't judge each other. That old exemption which you took, tax it separately. This new asset you tax separately. Okay, so whatever you exempted earlier will become taxable now. Whatever is taxable now will become taxable now. That is what the rules are. At the same time, 54F is also coming and saying that if you want to buy a house by selling some other asset, ensure that the day when you buy the house, you only have maximum one more house. You should never have more than 2 houses, including this house. Maximum you can have one more house, which means this house plus that one house, maximum 2 houses. If you have more than 2 houses, no more exemptions under 54F. Yes or no? Next, they're coming and saying 54 EC. EC is basically coming and saying that, boss,
if the property was bought by the assessing housemate, then that can be claimed with your or not.
Who paid the money? Then he's a deemed owner. If assessee paid the money for the spouse's house, then he's a deemed owner. No? The moment he becomes a deemed owner, then the asset is eligible for deduction. Permitted. Okay. Yes. Where were we? Doesn't matter. Deemed ownership does not care about it. No? It's an inadequate consideration of transfer to your spouse, so it's almost as good as yours. 54 EC. Now 54 EC basically comes and says that if you're planning to transfer any kind of immovable property, if you're transferring any kind of long-term immovable property, and if you're buying against that NHAI REC notified bonds. NHA, REC or notified bonds within 6 months from the date of transfer. If you're buying it within 6 months from the date of transfer, then I will allow a deduction of that as well. If you deposit capital gains, subject to a maximum of 50 lakhs, subject to a maximum of 50 lakhs in per asset per financial year, per asset per financial year, which means if the asset is already claimed 50 lakhs, next year you cannot claim it. Next year you cannot claim it. If the asset, overall many assets have claimed in this financial year, then you cannot claim the same thing in the next financial year. Yes, so 50 lakhs per asset per financial year. There they're coming and saying that, boss, if you're going to buy it within 6 months, anyway CGS is not applicable. And if you're going to buy a bond, you have to stick with the bond for a period of 5 years. If you don't stick with the bond for a period of 5 years, different asset, same asset. Different asset, which means exemption will become taxed separately and bond will become taxed separately. Bond will become taxed separately. In this, they have put one more extra condition where they're coming and clarifying that if you put the bond for a mortgage, if you put a bond for a mortgage or you convert the bond also, it is as good as transferred. It is as good as transferred. So you should keep the bond free of any charge. Free of any charge, then it is only not a transfer. These three you have to remember from exam perspective. In your book, you will find two more exemptions called 54B and 54D. Don't have to read. Don't have to read. In exam, just to keep in mind, if you see an asset which is being transferred, if you see an asset which is being transferred, and at the same time they're buying an asset, assume there is an exemption coming. Assume there is an exemption coming. Give off the exemption and close it off. Okay, rules will remain the same. Rules will remain the same. Same asset transfer acha, then it is reduced from the cost of the acquisition. Different asset transfer acha, exemption will be taxed separately. This will be taxed separately. Baki alla same rules. Baki alla same rules. You don't have to worry so much about it. Clear? Everyone? Yes. Great. This is what your exemptions look like. With your exemptions getting over, now you have understood what your capital gains is. Now you've understood what your capital gains is. The next question which then comes is how to tax the capital gains. How to tax the capital gains, which is where income tax is come and told. There are 4 kinds of capital gains. One is long term 112A, long term 112, short term 111A, and others. Income tax is coming and saying 112A and 111A are those cases where you have transferred any kind of listed equity shares, listed equity oriented funds, and listed business trust units. How do I use the word listed? You should have paid STT on those. You should have paid STT on those. If you have paid STT on those, then the income tax comes and says the tax rate will be 10% in excess of 1 lakh for 112A and 15% for 111A. If you are not transferring any of these assets, then it is 20% for LTCG and slab rates for STCG. Slab rates for STCG. This is what the format is. If you notice on the top, you will see with indexation, without indexation, and all those nonsense. Final level portion. Don't worry about it. Don't worry about it. Yes, coming to the 112A, they're coming and saying, Rahul, you have to transfer listed equity shares, listed equity oriented funds, and listed business unit trust. You'll get 10% in excess of 1 lakh. But here they have come and clarified that, Rahul, STT is paying mandatory. STT paying is mandatory. If you don't pay STT, then no 112A. No 112A, then it will become 112. Then it will become 112. At the same time, they also had to clarify that, boss, rebate is not eligible. Rebate is not eligible. You are not eligible for rebates. And then they came and clarified that, boss, if you have any kind of 112A, cost of acquisition will change. Cost of acquisition will change. How will it change, Rahul? They came and said, Rahul, if you have bought the asset after 1st February 2018, I don't have a problem. I'll take the direct cost. After 1st February 2018, I'll take the direct cost. But if I've taken the asset before 1st April 2018, I now have to come and do a computational mechanism. What is a computational mechanism? It is the sale value of the asset or FMV as on 2018, whichever is lower. That will be compared with the actual cost, whichever is higher. That will be compared with the actual cost, whichever is higher. This will become your new cost of acquisition. This will become your new cost of acquisition. Will be set off with your full value of consideration in order to arrive your capital gains. Rahul, can I claim indexation for 112A? No. No. Yes. Yes, this is your 112A. Can we repeat it together? What is it happening? They are saying it is fair market value as on 2018 or full value of consideration, whichever is lower, compared with your actual cost, whichever is higher. Whichever is higher. In your exam, in case they come and tell you to find out how the fair market value works out, it is the highest price as on the date of 2018. It is the highest price as on 2018. Assuming the asset was not listed on 2018, if it is a mutual fund, then it is the NAV price on that date. If it is shares, then it is indexed cost on that date. Then it is indexed cost on that date. Simple mechanisms. Simple mechanisms. It has been a while since they have tested all this, so they may not test it this time also. Okay, very long lead to happen. Yes, after you have completed 112A, they came and said you are into 111A. Whereas they came and said same assets, same logic, it is short term. Same assets, same logic, it is short term. The only difference is now you can claim rebate. Now you can claim rebate. Cost of acquisition will be the same cost of acquisition because the asset will be acquired after 2018. The asset will be acquired after 2018. Yes or no? Yes or no? This is what the computation mechanism is for short term capital gains. If it is any other asset, then it is 20% long term. Then it is 20% long term. And if it is any other asset short term, then it is slab rate model. Like I told you in the first start when we started, if you have a basic exemption limit which is not exhausted, you are free to use your capital gains against that, provided you are a resident individual. Provided that you are a resident individual. In the order of priority, you can choose to do 20, 15, 10. But if it's a rebate case, things become a lot more complicated. Let's not get there. Yes, this is what your computational mechanism is. Any doubts? No. Great. This marks the end of your chapter of capital gains. 2 more chapters which I have in my small part, which is called as business reorganization and transaction with owners. In transaction with owners, there are simple 2 things. One is called as liquidation, the other is called as buyback. Income tax is coming and saying that, boss, if you are going to do a buyback, tell me whether the buyback is happening for the shares or for securities. Tell me whether the buyback is happening for shares or securities. If the buyback is happening for securities, then capital gains will apply. If the buyback is happening for shares, then in that case, buyback tax will apply. What will apply? Buyback tax will apply. Income tax comes and says buyback tax is nothing but 20 plus 12% plus 4%. It is 20 plus 12% plus 4%. The company will pay it on your behalf. You don't have to pay anymore. You can exempt it off. But please understand, this is only for shares, not for securities. If it is securities, what will happen? Company will let it go. The assessee will have to pay tax as per capital gains. Same mechanism. Yes or no? Yes. Next item is your liquidation. Liquidation, like income tax comes and says, if at all there is any liquidation which is happening, to the extent of the accumulated profits of the company, the income will become deemed dividend. To the extent of accumulated profits of the company, the income will become deemed dividend. Balance items is what you can consider as the full value of consideration for the purpose of capital gains. So you split your income into 2. The money which you received will be split into 2. One is called as deemed dividend, the other is called as full value of consideration. Deemed dividend taxed under IFRS. Full value of consideration will become your sale value minus your cost of transfers, minus your cost of acquisition, minus your cost of improvement. You will get your capital gains. Simple, straightforward game scenario. Yes or no? Next, last item is called as your business reorganization. In business reorganization, they're coming and clarifying that, boss, if you have any kind of business reorganization, it is not taxable under Income Tax Act. Whether you call it amalgamation or you call it demerger. The only difference is, if at all it's an amalgamation, the cost for the new owner will become the cost of the old owner. Period of holding of new owner will be period of holding of old owner. Indexation of the new owner will be indexation of the new owner. It will not be from the old owner unless and until you choose for Manjulasha. Yes. Same thing in depreciation, ulta scenario. The asset of the new owner will become asset of the old owner. Asset of the period of holding of new owner will become period of holding of old owner. But if it's a share transfer, understand the share is getting split. So shares of the demerged company will be pro rata shares of the old shares. Which will be divided using the cost of the assets which were transferred to the new company. And the old company or the shares new price will become whatever you transferred, remove it off. In simple words, cost of acquisition for the resulting company shares is cost of acquisition of the old company shares into the assets transferred to the demerged company divided by the net worth of the old company. The cost of acquisition of the old company after demerger is the cost of acquisition earlier minus the cost to transfer to the resulting company. It seems simple, so therefore it's not coming. Yes, what is coming in exam is slump sale. Now in slump sale, they're coming and clarifying that, boss, if you have any kind of business undertaking which you're going to transfer as it is, what are you doing? You have a business undertaking which you're transferring as it is. In that case, it will be called as a slump sale. Income tax comes and says that, boss, whenever you're transferring a slump sale, you need to check for the same format of full value of consideration, cost of transfer, etc. etc. The only difference is full value of consideration will now not be the sale price alone. It will now not be the sale price alone. It is the sale price or fair market value of the assets transferred, whichever is higher. Whichever is higher, that will become your full value of consideration. This is same as your 50 CA, unquoted shares. Unquoted shares with the same logic. It is the actual consideration or fair market value, whichever is higher, minus the cost of transfer. You will arrive at net consideration minus the cost of acquisition. Now, when it comes to cost of acquisition for a business, cost of acquisition is nothing but the net worth. How do you find the net worth? Net worth is nothing but A minus L. Assets minus liability. In assets, you have many assets. One asset is called as fixed assets. You will take the value as WDV as per income tax. You have other non-current assets. Book value, other current assets, book value, everything is book value. But if you have done any kind of goodwill, zero. Any kind of revaluation, ignore. If you have any kind of liabilities, book value. Any kind of liabilities, book value. So you take your assets minus liabilities, this will become a net worth, and you will not have any kind of cost of improvement. Therefore, it will become your capital gains. Now, capital gains may be long term, may be short term, depending on the period of holding of the date of incorporation of the business. Date of incorporation of the business. But even though it is long term or if it is short term, it doesn't matter. You cannot claim indexation. You cannot claim indexation benefits. Yes or no? Yes, great. This marks the end of a chapter called as capital gains also. Yes.